This is the Savvy Investor radio show and podcast. For help with your retirement, schedule a 15-minute phone conversation with the team at ProStatus Financial Advisors today. Just call 866-597-1040 and at thesavvyinvestorradio.com.
Welcome once again to the Savvy Investor Radio Show and podcast with the team at ProStatus Financial. Ryan Herbert is here with me today, and we are post-tax season. And Ryan is going, big deep breath and say, extension, see you in a month, right?
Yep. Well, for most people, when it comes to the extensions, it's, they unfortunately, most people choose to wait until, October 1st, when the deadline's October 15th. They wait to the last possible minute to request an extension, and then they wait for the last possible minute to do the taxes. So, for those people out there, if you do request an extension, I understand it, I get it. But please get the stuff to your tax preparer before October 1st so that the stress doesn't ramp up again like it inevitably always does.
Well, we do this show in many instances for people getting ready for retirement, telling them what they're in for and just saying, hey, there's some planning that can take place that can ease some of the pain of taxes later in life. I would like to key in on the people who are retired right now, because people who are going into retirement feel, I'm not going to be writing the check to Uncle Sam when I'm in retirement. I'm not working anymore. There's less income or whatever. And then all of a sudden they do their taxes and they go, what happened? I'm still writing a check to Uncle Sam. So there's a bunch of people this week that are coming to that realization and saying, Ryan, how do I not let this happen again? What steps can I take that I can actually get a refund next year? So what are people doing wrong in retirement where they're still writing checks to Uncle Sam, and how can we fix this?
I think that one of the biggest surprises for most people often happens the very first year that they retire, simply because for most people, they're not retiring on December 31st. Most people are retiring at some point throughout the year. Most teachers, they'll finish out the school year and then they'll work a month into the summer. And then, July 1st is what their retirement date is. Mm-hmm. And then they start taking money out of their IRA. They start collecting their pension. They turn on Social Security and they start collecting all these income sources, thinking that the income that I'm now receiving because I'm no longer working, I don't have that income anymore. This is where my tax bracket is. I should only withhold about 10 or 12 or 15% or whatever that number happens to be. And most people completely ignore all the income that they had earned prior to that point, or they forget about, the leave payout or vacation payout or any type of bonuses. So oftentimes that very first year of retirement, when we go to do the taxes, they often owe a significant amount because they often forget about, like I said, that other income. So that's one thing you have to be cognizant of. Mm-hmm. And then when people have been retired and it's, their first couple years of retirement, they're still really trying to figure out what retirement really looks like for you, what spending looks like, because we go into retirement with this conception of I'm going to be spending X amount of dollars per month, $5,000 per month. But then in those first couple years of retirement, you're often spending more money those first few years because you're doing those fun things in retirement. You're taking those trips. You're accomplishing the honey-do list. You're remodeling the kitchen. You're remodeling the bathroom. And we've created this income stream that says, okay, I need to have $5,000 a month, or you've created this income stream. And then all of a sudden, I really want to take this trip. Let's take another, $15,000 out of the IRA, we'll pay some tax on it and drop it on, and then we'll be able to take this trip. Well, not thinking about the implications that extra $15,000 can have on the overall tax situation. Depending on where your income is, you could be paying nothing on Social Security. You could be paying tax on 50% of your benefit. And if you're paying nothing and you take some extra income, you go over that threshold for Social Security, all of a sudden you weren't paying tax on any of your Social Security. Now you're paying tax on half of it. So the tax implication jumps everything up. Your taxes go up. Same thing if you cross that threshold from 50% to 85%. So depending where you're taking the income from in retirement really matters, because every area can have a different tax implication. If you're taking money out of Roth, as long as it's been open for 5 years, there's no taxes there. If you're taking money out of your brokerage account, it could be tax-free because it's just cash that's sitting in there. You might have to sell some positions in your account. That could be, If they're long-term positions you've held, that's capital gains income. But if you've held them for less than a year and you're realizing gains, well, that's ordinary income. Most people don't think of the differentiation between those two types of money. If you're taking money out of your IRA, your 401k, your TSP, that's all ordinary income. So you have to understand the taxability of the money that you're adding on to your income and how it's going to affect everything else on that tax return, because a small $1,000 distribution can increase, you can owe about 40% tax on $1,000 just based on, I take that $1,000 out and it changes my Social Security tax, it changes my tax bracket, it changes everything. So that extra $1,000 actually costs you $400 in taxes. It's really a complex situation that most people don't think about. And, there's often these myths out there in retirement. The most prevalent one being that, Social Security is not taxable. Social Security can truly not be taxable. But for most people living in Maryland that I see, without proper tax planning, Social Security is taxable. There's this other myth that, there's at some point in life where you don't have to pay taxes anymore. I hate to be the bearer of bad news. There's two things in life that are certain, is death and taxes. There is no magic age to where you're not paying taxes. I would say, one of the worst conversations that I did ever have to have is I had a woman who was referred to me by a client of mine, because she'd been doing taxes for herself for years and years and years. And she had just retired, and she actually retired, in November. And she was retired for an entire year that following year. And she came to me because, I normally do my own taxes, but I retired. I've got, all these different 1099s, and I moved from Maryland to Delaware. So I'm really not sure, how to do the taxes since Delaware is tax-free. And I was like, wait a minute. What do you mean Delaware is tax-free? She goes, yeah, there's no taxes in Delaware. I said, oh, no. There are income taxes in Delaware. There's no sales tax in Delaware. And the look on her face when I told her that was this look of utter shock and horror, because she had been taking all this money out of her accounts and not withholding any tax in Delaware. And I think when I did her taxes that year, I think she ended up owing like $8,000 to Delaware that she hadn't budgeted for. And, all of a sudden now she didn't have the money in her bank account. She had the income that she needed coming in. And all of a sudden we have to take an extra $8,000 out of her IRA, because that's the only area she had money, take an extra $8,000 out of her IRA, drop it onto her tax return. What did that do to her tax return? Well, it increased her taxes. Once again, she would have to pay money that she didn't have. And so where was she going to get that money? By taking it out of the IRA. So it can create, without proper tax planning, can create these vicious cycles of robbing Peter to pay Paul, essentially. But proper tax planning is not trying to get myself to 0% tax planning. Proper tax planning is making sure that at the end of the year, you're not due for a surprise. I never like having those conversations with clients that, oh, hey, by the way, we've done your taxes. Now you got to write the government a check for $5,000 or $10,000 or, $60,000, $70,000. Like it has happened for some people where, they take these large distributions from their 401ks, they drop it onto their income tax return, and they're not realizing, the true implication of that, because they're not realizing the true implication of what that has on their tax return. And last year, I have another client, comes to me just for taxes, been doing his taxes for years and years and years. He and his wife decided they were going to take money out of his TSP to buy a piece of property in West Virginia, because ultimately that's where they wanted to retire. They were in early 60s, still working for the government. So he took out about $200,000 from his TSP. And when he talked to TSP, he asked them, how much money should I have withheld for taxes? They said, oh, we recommend 20% federal, and your state tax rate is about 6.5%. So let's say you do that. So he withheld 20% federal, 6% state taxes. I go to do their taxes that very next year. They owed a ton of money in taxes. And he came back to me and he was, understandably very upset with the fact that I was telling them they owe, combined between the federal and state, about $20,000 in taxes. And he just kept saying, I paid the taxes. You did something wrong. And I had the conversation. I said, Cal, you have to think about, yes, you did pay those taxes because you asked the TSP person on the phone, what should I do in taxes? And they just gave you a number. They didn't think about the fact that you and your wife combined make about $300,000. They didn't think about the fact that if you take this $200,000 and drop it onto your tax return, it's going to put you up into that 35% tax bracket. So not only did we under withhold on this distribution from TSP by doing 20% instead of 35, all of your other income from you guys working throughout the year was being taxed on you guys making about $300,000 a year at that tax bracket. It wasn't being taxed on the fact that now you guys are going to be making $500,000. So that $200,000 had a much bigger tax implication. And it's just one of the things that people don't think about. When you're asking, the 401k company or the TSP or your IRA company or your advisor, for that tax advice, most often you're just going to get these blanket statements of, what we recommend is 20% or the minimum amount we do is 20% or we automatically withhold X percentage, not thinking about all the other ramifications. While yes, that distribution alone in a vacuum for him would have been taxed at 20%, the fact that you're adding it to all of your other income really can change those situations. And, it's one of those things where you want to be working with the right people. You want your advisor to understand the tax consequences of the money that they're managing. You want your tax person to understand everything you have going on in your investment world, because the two of them are so drastically intertwined that it's more often than not the one area I often see these tax mistakes. When people come to us, they come into the office, whether they've listened to our podcast, they've listened to our radio show, they've attended one of our seminars, they come in because they have tax questions. Everybody always feels like they're paying too much in taxes. And more often than not, they have one outstanding issue that they always want to point to. And 9 times out of 10, it's always because whoever gave them the advice for here's what you should do for taxes was giving them this advice in a vacuum and not thinking about the entire picture when it comes to taxes and your retirement income.
Moving into retirement, it's like there's a whole re-education when it comes to income. For all these years, you've worked for somebody else and they gave you a paycheck and that was your income. That's what you wrote down on your tax return. But now there's provisional income, there's Social Security, there's pensions, there's annuities, there's interest, there's capital gains, there's dividend paying stocks. There's all different ways that you get paid in retirement, and it all has different tax treatment. Let's figure that out together, and that's what the team at ProStatus Financial can help you do. Go to our website, which is thesavvyinvestorradio.com. There's a place for you to put a little information in there, and the team will reach out to you. You can also give the team a call at 866-597-1040. 866-597-1040.
Advisory services offered through ProStatus Financial Advisors Group, a registered investment advisor. Insurance licensed in Maryland. ProStatus Financial Advisors Group, LLC is not licensed in all 50 states. To find out if ProStatus Financial Advisors Group is licensed in your state, please call 410-863-1040. ProStatus Group, LLC is not affiliated with nor endorsed by the Social Security Administration or any other government agency and does not provide legal or tax advice. Annuity guarantees rely solely on the financial strength and claims-paying ability of the issuing insurance company. By contacting us, you may be provided with information about insurance and annuity products offered through representatives of ProStatus Financial Advisors Group.